In financial literature, the stock market is generally characterized as efficient. This idea, known as the efficient market hypothesis or EMH, rests on 5 key assumptions. Stock prices respond to new information immediately, there are no arbitrage opportunities, investors have equal access to information, past prices do not predict future performance, and most importantly, investors act rationally. Essentially, the EMH suggests that stock prices correctly reflect all publicly available information which investors trade on rationally. However, real-world financial markets often deviate from these assumptions, resulting in drastic price fluctuations and market inefficiencies driven by the irrational decisions of investors. But what if I told you there was a force operating behind the scenes, secretly pulling the strings and orchestrating these irrational moves? A force so powerful that it shapes the behavior of millions of investors, yet it's rarely discussed and never taught in finance classes. This hidden force has a profound impact on the markets, guiding us to make decisions that are far from rational. So are you ready to meet the true puppet master behind the scenes? It's not some malevolent actor, it's your brain. Our brains are wired to make decisions based on emotion, cognitive biases, and heuristics, which often lead us astray in the markets. These mental pathways can cause us to overreact to news, follow trends, and make irrational choices, fueling the very market efficiencies that the EMH overlooks. But to truly understand the concept, we need to look at a real-life example. This is Cisco, and back in the 90s, Cisco was growing steadily selling telecommunications equipment. Despite posting relatively average financial results and experiencing slow growth, starting in 1997, Cisco's stock price began rising at an unprecedented rate. Since no extraordinary new information had come to light about the company, based on what we know about the EMH, this increase made no sense. But around this time, the explosion of the internet was causing investors to exhibit some pretty strange behavior. This was resulting in internet and telecommunications companies' share prices getting driven up to meteoric heights. This period is known as the dot-com bubble. But like I said, it wasn't rational decision-making driving this price explosion. Instead, it was our own brains. More specifically, the prefrontal cortex, amygdala, and nucleus accumbens. These are the areas of the brain that are responsible for decision-making processes, including impulse control, emotional reactions, and reward-seeking behavior. So during this dot-com boom, investors weren't analyzing businesses rationally. Instead, their brains were being hijacked by overconfidence, recency bias, and dopamine surges. Because the brain has such an effect on these decisions, a new area of research called neurofinance has emerged. One study in the field explained this phenomenon perfectly, stating that individuals tend to react emotionally, not rationally, when dealing with a stressful environment. In this case, it was the fear of missing out, which is an emotional trigger deeply wired within our brains. And just like that, investors piled in. Cisco, which was once a steady growing company, quickly became one of the most valuable firms in the world. Not because of a sudden transformation in its business, but because of the same neurological forces that once helped humans survive in the wild. By early 2000, Cisco had reached a staggering market cap of over $500 billion, making it the most valuable company in the world. But as history shows, bubbles don't last forever. The same cognitive biases that drove investors to pile in also led them to panic when the tide turned. So as internet companies began to fail and the reality of unsustainable valuations set in, fear took hold. The brain's amygdala, which is also responsible for processing fear, triggered a widespread sell-off. And suddenly, the optimism that had fueled the boom was replaced by loss aversion, a bias where the brain feels the pain of loss more intensely than the joy of gains. Investors scrambled to exit their positions, and the dot-com bubble had burst. And Cisco, which had once been the poster child of the internet revolution, saw its stock plummet by nearly 90% from its peak. Despite being a fundamentally solid company, the same irrational behavior of the brain that had inflated its value resulted in it coming crashing down, which left many investors with significant losses. This cycle of excitement, overconfidence, fear, and panic is a perfect demonstration of how the brain's influence over decision-making can create extreme market volatility. In fact, Neurofinancial research has shown that the same neural pathways involved in gambling and addiction are activated in financial speculation, further explaining why investors often behave irrationally. So what can we learn from Cisco and the dot-com bubble? Recognizing the role our brain plays in financial decision-making is crucial. By understanding cognitive biases and emotional triggers, investors can take steps to counteract them, whether it be by adopting a disciplined investment strategy, using data-driven approaches, or simply acknowledging the fact that markets are heavily influenced by human psychology. Additionally, recent studies have found that our brains might not just cause irrational decisions, they could also hold predictive power. A study by researchers at the Rasmus Center for Neuroeconomics found that professional investors' brain activity in the nucleus accumbens, which is a region linked with reward anticipation, can potentially predict future stock performance better than conscious predictions. Using fMRI technology, the study recorded brain activity as investors analyzed real-world investment cases. Shockingly, these scans revealed that gut reactions and initial impressions played a significant role in identifying successful stocks, outperforming conscious predictions. This discovery could suggest that neuroforecasting, or using brain data to predict market trends, has future potential in financial forecasting, although further validation is needed. Altogether, exploring the brain's role in financial decision-making is essential for understanding market behavior and improving on our investment strategies. By acknowledging how the brain drives irrationalities and exploring emerging fields like neuroforecasting, we can develop better tools to navigate financial markets more efficiently. So the next time you find yourself caught up in a market frenzy or panicking over a downturn, remember, the biggest force moving stock prices might not just be the news, earnings reports, or interest rates. It could just be the biology of the human brain.